So as we're going in a very tough environment in 2023 in terms of the macro environment, in terms of earning, in terms of consumer spending, many of you are trying to buy stocks that could potentially hold up better than others, or I can actually beat on earnings, some type of necessity type of stocks. And many of you have asked me about CVS. What about CVS? It's in the healthcare space. No one really cuts on healthcare. And especially as they own Aetna, which collects a lot of premium from many people, which they cannot really cut on. And it should hold up better than other type of stocks in such environment. And I do agree about that stuff. And I'm going to review CVS today, which is a very interesting stock in my opinion. Now, looking at CVS, it pretty much bottomed in 2019, a little bit after 2018, whenever they announced that they're going to acquire Aetna. I remember the stock going down a lot. And it was around a $70 billion acquisition, a huge merger between Aetna and CVS. And the market was basically saying that CVS doesn't know what they're doing and it's not going to be successful. But CVS did prove otherwise, and the stock has been on a pretty big run actually since it bottomed around 2019. And CVS has done a lot of acquisitions since then, and they have proved that those acquisitions were actually valuable, and they were able to grow a lot of revenue and a lot of net income from such acquisitions. Unlike Walgreens, which is more focused on the dividend and returning value to shareholder, CVS is also focused on their dividend, which is like 2.3, 2.4%. But they are also focused on growth through acquisitions and in a couple of other areas. And if we look at CVS, it's not as expensive as you think. If we look at the enterprise value to free cash flow, and again, we're looking at enterprise value because it includes debt, and CVS does have a lot of debt, it's trading around 9 times enterprise value to free cash flow, which is one of the cheapest ever on the history of CVS, which I have since pretty much 2013. The mean was around 15.7, as high as 30, and as low as 8.9, and now it's around 9.1. So it's a pretty low multiple on a historical basis. But CVS does have, a lot of problems, but it has been doing pretty well actually in 2022, despite all the things we were having and a lot of companies missing on earnings. CVS actually grew revenues 10%, and they grew EPS around 6.1%, and they even increased their guidance, which is pretty amazing from CVS. But if you look at the GAAP loss per share, they actually lost $2.60 in the third quarter, and that was mainly because of some opioid type of expenses that they had to do, like this one, the opioid litigation charges, which was around $5.2 billion. Then they sold some assets, and they put a loss of around 2.4 billion or in type of expenses. I'm not sure which assets they sold. I haven't looked into it, but this was the reason why the net income was down. But if you adjust for the earnings per share, it was actually up 6.1%, which was pretty amazing again from CVS. And they are using this free cash flow to actually pay back debt and actually return value in terms of dividends. And again, the main case for CVS was a lot of debt from Aetna. And CVS has paid around $25.2 billion of long-term debt since they closed the Aetna acquisition. I believe it was in 2018 or early 2019. And they paid down $2.6 billion of long-term debt in the third quarter of 2022. And the company does have a lot of debt, but they have been decreasing it. It peaked in 2018 around $70 billion of debt. Now it's around $49 billion of debt, and it's actually been going down. And I hope CVS can just, slow it down in terms of acquisitions and actually start paying back the debt a little bit quicker, as they have $2.5 billion of interest expense every single year. This is massive shareholder destruction. This is like almost 1.5% of their market cap, if it's not actually 2% of their market cap, I believe. But again, $2.5 billion of interest expense every single year This is a lot for a company like CVS. But if you look at the debt in general, it's not really as expensive as you think to carry it. Most of the loans, again, as you could see here, 3.5%, 4.7%, 2.8%, nothing pretty much above 6%. Most of it is actually between 1% to 4%, which is not a high interest rate, and it's locked in all the way up to 2050, which I believe CVS got a very good deal in terms of the debt. But again, $2.5 billion of interest expense every single year is a lot, in my opinion, and I believe CVS should, and I hope they do, take the debt more seriously, slow the acquisitions down a little bit, and actually focus more on their debt. And they did give a 2023 outlook, and they expect high single-digit growth in terms of EPS, which is between $8.70 to $8.90. So again, this is how much visibility CVS has, and it's mainly from the premium that it collects within Aetna. So again, we did look at CVS business model. We believe that CVS will likely, actually grow earnings in 2023 in a global recession, where you're going to have a lot of other companies missing on earnings. And we looked at the historical multiple of enterprise value to free cash flow, and we determined that CVS is pretty much as cheap as it was on a historical basis. But it's time to look at my valuation model to make sure of those numbers and determine if CVS is actually a buy or not. Now, in revenue, it made around $314 billion of revenue in 2022 for the estimate of 2022. In 2023, if you remember, they said high single-digit type of revenue growth, so I put in 7%. And as the analysts, they were expecting 4 to 5% between 2024 and 2027, so I did use 4%. And this does not include if CVS potentially close on more acquisitions, which actually fuel the revenue growth much, much more. But I believe CVS can easily achieve a 4% revenue growth in terms of hiking prices and doing a couple of other things. But I believe, again, 4% revenue growth is fair. Now, their net income is actually 3.8%, not 2.8%. So 3.8% net income margin and a PE ratio of 12, which is their historical average. Now, CVS is trading pretty close to a 10 PE ratio. Their average was between 12 to 14. So I used a 12 PE ratio, and I believe this is fair, even a little bit on the lower end for a company like CVS, especially if they were able to fuel the revenue growth beyond 4%, it could get around a 15 multiple. But again, I'm not betting on it. But using a 12 PE ratio, we got around $179 billion market cap, which is 61% on the upside 5 years from now. Including the dividend, you get about an 11% return every single year for the next 5 years. Now, this is not a bad return at all, especially if you're a conservative investor looking for a safe 10-11%. And this, again, does not include if CVS gets a multiple expansion to 15. And if it does get a multiple expansion to 15, then the upside is more than a double or even 16% compounded every single year for the next 5 years, which is an amazing, amazing return. But for me, as I like to double my money every 3 to 5 years, for my personal taste to be buying heavily into CVS to get it double, I would need to buy CVS around $72 per share. Now, I'm not saying that you shouldn't buy CVS right now, because I don't believe CVS is actually expensive in my opinion, but I did show you the return you get with a 12 PE, which is around 11% yearly return. And if this is the return you're looking for, then I believe CVS is actually a buy, and it could potentially hold up better than other stocks going into 2023. But if you're looking to double your money over the next 3 to 5 years, especially over the next 5 years, in my opinion, CVS would need to be bought around $72, maximum $75 for you to double your money with CVS. So this was my review on CVS stock. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.